February is going to be a month of harsh financial reality for individuals and the country as we come to terms with a high budget deficit, and there is concern now over the possibility of South Africa defaulting on its debt. Is that a reality? What would happen if we do? It's a crucial question. Joining me now, Thursday lunchtime, Johann Els, Chief Economist at Old Mutual. Johann, good afternoon to you. Is the climate currently pointing to a debt default?
Actually, no. Last year we thought we're getting closer to that, but since then the economy has started improving. We expect very strong global growth that will help South Africa as well. So with a better growth environment, it makes it somewhat easier to get to a slower, lower budget deficit and thus start to stabilize the debt to GDP ratio. So I think talk of a debt default within the next 5 years in South Africa is scare talk. I think the probability is very low regarding that. Doesn't mean we have to stop this process of fiscal consolidation. We absolutely need to keep on doing that, cutting back expenditure, getting the country to a higher growth path in order to reduce that risk. But for now, I think the probability is low in the short term.
Do you believe that government is cutting back on spending quickly enough? I mean, you'll be well aware, of course, of the difficulties regarding the standoff with public service unions, for instance.
Yes, absolutely. So the focus on freezing the public sector wage bill in order to cut that government spending is, of course, a big risk in terms of implementation. I think, though, that government is more serious than what we thought. Government is going to do their utmost. Whether they will be able to convince the unions, that is the crucial question. But we cannot be complacent about this. Government has started cutting back on other areas as well, but the wage bill, being a third of total government spending, has ballooned significantly over the last 10 years or so. This is the area we absolutely need to focus on, and we need to keep on hammering away at that. The risk is very clear, though, that the aim of freezing the wage bill for a 3-year period, we might not get there. But at least then hopefully we get to a position where wage increases in the public sector can be limited. But I think the unions also need to realize that government is serious about this, and that if there's no wage freeze, then of course there's going to be some layoffs, even if that's just through natural attrition. But the public sector, the size of the public sector employment needs then to slow as well.
It's not just, of course, about freezing the public sector wage bill. It's also about, I imagine, the broader government economic recovery plan. Do you think that is sufficiently geared to scaling back debt, and is it being implemented quickly enough?
Well, Jeremy, that's a very good question, because you rightly say that growth is a big part of solving this fiscal problem, higher economic growth. We had a big last year. We haven't got the final number yet. But given the very strong global growth environment, I think we can rebound quite strongly this year. But then people will say, hang on, that's just a rebound from last year. So more important is, what is the medium-term growth outlook? We take a step back. In the 5 years to 2019, annual average economic growth was just 0.8%, quite dismal. But I think stuff that has happened over the last 2 years or so, and I'm first in line to say it hasn't been enough, it hasn't been strong enough, it hasn't been implemented enough, but there's stuff that has been happening, and I think we can aim for, well, we can look forward to somewhat better medium-term growth. If we talk about annual average growth from 2022 onwards, I think a conservative estimate is 1.5% to 2%. Now, that's still not enough, but it's far better than the 0.8 that we had in the 5 years to 2019. So we're moving in the right direction, and you and I acknowledge that it's too slow, but at least we are moving in that right direction in terms of better growth, in terms of working down government's excess expenditure, in terms of slowly increasing taxes. Unfortunately, that's slow compared to the cutback on the expenditure side. We're moving in the right direction on both the fiscal side and on the growth side.
And just a final question to you. All of that is predicated on real foreign appetite for renewed investment in South Africa. We've had lots of promises made. I'm not entirely sure how many of those have come to fruition. It's all about the optics. Are Is there that appetite for investing in this country right now, do you think?
Well, two parts to that answer is firstly the portfolio flows. In this risk-on environment, far better global growth environment, better emerging markets outlook, better returns in emerging economies. South Africa will get its fair share of that. Foreigners chasing yield, getting better returns in South Africa than in many other countries. So despite weak fundamentals, we'll still get that part. And, as the fiscal situation stabilizes, as growth slowly picks up, then I suspect that we'll start to see an uplift in that other investment trends as well, the foreign direct investment, people, investors, entrepreneurs coming to South Africa and willing to build and open a factory, that kind of direct investment. I think that trend should also improve in line with the better growth outlook, in line with our fixing the fiscal situation, etc.
Well, at least there is a little head of steam that is being built up. I appreciate the analysis. Johann Els is the chief economist at Old Mutual.